Hello and welcome to this boardroom. Today we are interviewing the top management of Tata Steel. The numbers have been very pleasantly surprised this week. Sales has been above 5% and bottom line is up 17%, and even on the margins they have done a splendid job. So let's go across to the top management and start by asking the MD Nerurkar. So this quarter has been a very good quarter in terms of volumes, but can you throw light on the realizations picture, how it has been?
The realizations compared to last year are certainly lower, but our realizations haven't gone down with the market as much as the others have gone down. And the reason is that our product mix is better and our product quality is better. Our other thing why the margin has gone up is because our cost reduction efforts have given us a significant boost, and that numbers Kaushik will talk about. And thirdly, volume, of course, you mentioned. So volume, net realization and the cost reduction efforts, these three have given us a lot of benefit compared to, let's say, the most of the industry.
But there's also a doubt that you had a price hike in December, and was most of the sales done in December on a higher cart rate? Was that one of the reasons?
No, the price increases in December came in the last week, so most of it is effective from first week of January. So in fact, if somebody picked it up, somebody must have picked it up at a lower price than the higher price. But that's not the issue. The issue is the prices in October, November were low. December there were announcements or expectations. The effective date is from January actually.
Kaushik, let me touch upon the margins front. The margins have been going up for the last 3 quarters. You had 31% in Q1, 35% in Q2 and now 38%. What is the level of margins which you are comfortable going forward given the trend which you are seeing in the market now?
That may be an unfair question to a company, but I think if you really look at it, if you talk about the highs, in September 08, our margins or the EBITDA margin was 49%, and that was at the high end of the cycle. If you really look at the main contributors for margin increases, it's effectively price, it's the volume because it takes the fixed cost down, and it is on the improvements on the operating practices as well as on the cost side. We have, if you really look at the last 3 quarters and even earlier on, moved the performance improvement targets bigger and bigger, and this quarter it's almost 630 crores compared to the same quarter last year, and that's a big change in the total EBITDA of 2,400 crores. On a mid-cycle basis, this would reflect a margin of around $300 per ton EBITDA margin, which I think is in the range of where we are in the cycle, where we are in terms of the global prices and the raw material costs and so on. And I think that's the kind of range we would like to sustain.
Will the margins can scale up the 40% mark given the fact that you undertook price increases in the last week of December, and then those impacts will come in the Q4 of this quarter?
See, it would be a bit speculative to say whether it will move 40%, 42% or remain at 38%. I think the whole effort within the company goes towards reducing cost by improving product mix, by improving the operational parameters. For example, our coke rate has improved. We are replacing coke with our own purchased coke with our own coke. The raw material cost on coal has gone down, and improving the mix of the product so that we get a higher NR. We produce tubes, we produce wires, which